Hello everyone, welcome to the learning series at EduLite. Now we've been interacting with a lot of students and primarily two challenges is what students have shared with us. One is that they're not very strong when it comes to understanding a particular concept. And the second challenge is even if they understand the concept, they don't know how to practically apply it to real life scenarios. Now through the next series of certain videos, we will pick up certain topics and help you build your conceptual understanding as well as give you tips in terms of how to apply them in real scenarios and also apply them in your exams. Now remember this, if your concepts are weak and if you don't understand how to apply them, it will not only be difficult for you to clear professional exams, but it will also act as a bottleneck to your long-term career goals. Now let's pick up a topic here, and this is one of my favorite topics as well, which I've brought in from the financial statements of the company. Now we all know how many financial statements are prepared. Any guesses? I'm assuming that all of you are aware that there are three primarily financial statements. The first one being statement of profit or loss, which is also known as statement of comprehensive income. The second one being statement of balance sheet, which is also known as statement of financial position. And finally, we have the cash flow statement. Now, once the financial statements are prepared, it is important to analyze every line item to understand the health of the company. Now, standalone numbers do not communicate a meaning, and that is why we make use of ratios. Now, in addition to the monthly, quarterly, and half-yearly or annual trend analysis that we do to understand the trends of numbers, ratio analysis is an effective way to understand different line items and overall health of the company. Now ratios could be of different types. They could be profitability ratios, they could be balance sheet ratios, they could also be market ratios. Now in today's video, I'll talk about one ratio from the balance sheet, which is called as current ratio. Now this is one of the most simple used ratios, but most widely used ratios as well. Now let's first understand what is a current ratio. Now current ratio helps you to understand the liquidity position of the company. So if tomorrow the company has to pay its liabilities, what is the liquidity that they have to pay them off? Now let's look at the simple formula for current ratio. Current assets divided by current liabilities. Now current assets, cash in hand, cash at bank, debtors, inventories, prepaid expenses, they're all classified as current assets. So pick up the current assets from your balance sheet, pick up your current liabilities. Now current liabilities are creditors, bank, other small payables and others. So if I divide my current assets by my current liabilities, I get a simple current ratio. So let's say my current assets are 200, my current liabilities are 100, my current ratio becomes 2:1. Now current assets are those which the company uses for the period of 12 months and current liabilities are those which the company has to repay in over 12 months. Now this is how we calculate the current ratio. Now, it's a very simple terms. We've understood what is the current ratio and how do we calculate it. Now in the next video, I will talk about the practical application of the current ratio.